Welcome back to the Deep Dive. Today, we are buckling up for an exploration of the global economy's most thrilling and maybe its most fragile driver right now.
It's a real tug of war.
It is. We're looking at this titanic struggle between, on one hand, explosive trillion-dollar AI investment, and on the other, these fierce, non-negotiable regulatory demands for sustainability.
And these two forces seem completely contradictory, but they are, right now, rewriting the rules of modern capitalism.
It's an unprecedented economic moment, for
It
sure.
really is, and we've
Yeah.
compiled a deep stack of sources to try and make sense of it for you. We're pulling from everything, from detailed financial analyses from major firms like Credit Agricole and Alpha
Okay.
to the actual regulatory blueprints coming out of the European Commission on Ecodesign, plus, specific U.S. tax and executive orders that are designed to do one thing: accelerate this infrastructure build-out.
And we're also looking at the companies themselves, right?
Exactly. The detailed corporate strategies of giants like Microsoft and Micron to see how they're responding on the ground.
So our mission in this deep dive is to unpack the extreme interdependence between these key tech companies, this idea of a circular financing loop that is, and this is the key, actually fueling the entire economic boom.
Right. And then to understand how that high-stakes game, when you combine it with these new mandatory circularity rules, is what's driving global momentum.
So in essence, we're looking at how a very small group of companies, through some really complex financial moves, are basically acting as the primary engine for global growth.
And at the same time, governments are scrambling to regulate their environmental footprint before that engine, completely overheats.
We really need to understand not just the numbers, but the dynamics here, the mutual dependence.
Exactly. What does Nvidia need from OpenAI? What do the cloud providers need from both of them? And how does that create this guaranteed revenue for everyone, keeping the economic gears turning right now?
The scale is immense, the risks are concentrated, and the long-term mandate for sustainability seems pretty irreversible.
It's quite a story.
Okay, let's unpack this.
To really understand the intensity of what's happening in the economy, you have to start with the sheer magnitude of capital expenditure, CapEx.
And the money being pumped into what the industry has started calling the AI factory.
Right. And it's so important we define that term right away because it's a very specific thing.
This isn't just, building another data center, the real estate, the power supply. We've been doing that for decades.
Exactly. The AI factory refers specifically to the compute and networking equipment. We're talking about the GPUs, the specialized servers, the high-speed interconnects, basically all the gear required to make large-scale generative AI actually work.
And that is the new highest cost component of the modern economy.
Without a doubt. And the money flowing into just that specific category of equipment is, well, it's staggering.
This is the numbers.
Global estimates suggest that just the top 11 cloud providers, the hyperscalers, are on track to invest more than $390 billion globally.
Just in AI infrastructure CapEx.
In a single year, 2025. That is an incredible concentration of spending.
And if you look inside that $390 billion number, how much of it is for that core equipment?
The vast majority. Around 75% of it is going directly to that specialized compute and networking gear, the AI factory itself. That density of capital is what makes it such a powerful driver for industrial production.
To really get a sense of the physical scale here, I was looking at the comments from Nvidia's CEO, Jensen Huang. He estimated that a single, massive 1 gigawatt AI factory,
Which is a colossal facility.
truly colossal. He said it could cost up to $40 billion.
$40 billion for one facility.
Yeah.
That really puts the scale of this investment outside the realm of, typical infrastructure projects. We're talking about capital requirements that rival the annual GDP of small developed nations.
Wow.
And it's all going to these specific high-tech compute clusters.
And it's also incredibly sensitive to the technology cycle.
Right. And this isn't a peak. It's not a one-off thing. When you zoom out and look at the longer horizon, the overall AI infrastructure expansion is projected to hit a cumulative total somewhere between $3 and $8 trillion by 2030.
That range alone, a $5 trillion spread, tells you everything.
It tells you two things, right? First, the sheer size of the opportunity. And second, the profound uncertainty about the pace of adoption and, how quickly this stuff will pay for itself.
And if we connect this to the bigger picture, this spending isn't just important for the tech sector. It's become an economic anchor for everyone.
It's the economic anchor. AI-driven CapEx is the crucial source of growth. That record $350 billion in AI infrastructure spending in 2025 It wasn't just absorbed by the market. It fueled exceptional strength across tech equipment, software, and the entire manufacturing supply chain needed to support it.
And this concentration of capital has these disproportionate effects on the market as a whole.
Absolutely. Data analyzed by institutions like Credit Agricole suggests that AI CapEx has been the primary engine of economic and industry growth. It's driving a massive share of the S&P 500 gains of corporate earnings all through 2024 and 2025.
And this is where the macroeconomic risk starts to creep in, this intense focus on AI.
Well, what's fascinating and a little terrifying is the analysis suggesting that without this constant, intense AI spending, the U.S. economy might actually be in a recession right now.
Wow.
Seriously.
Yeah.
This spending is acting as a major economic stabilizer. It's masking these cooling trends that are pretty evident in other sectors like traditional manufacturing or consumer spending.
So the reliance of the broader market on this one single sector for growth is just enormous.
It's enormous, and it's structurally fragile.
Which makes the industry itself an indispensable cog in the economy, whether you're invested in AI or not.
Right. But this engine of growth has a really serious internal conflict.
And that's the speed of technological obsolescence versus, well, standard accounting practices.
Absolutely. Think about the hardware. A GPU is typically depreciated over a 5 or 6 year period on the books. That smooths out the cost over its useful life.
Which seems reasonable for a piece of hardware.
It would be. But the pace of semiconductor design is just breakneck. You have this constant jump from the H100 generation to the B200 and now beyond. Firms feel they have to buy the absolute latest generation the second it's available.
Because they can't wait 5 years. If their competitor adopts the B200 and gets a 30% performance advantage in how fast they can train their models, well, that puts them at an immediate, maybe even an existential disadvantage.
Precisely. The demand isn't for simple replacement after the old gear wears out. It's for fresh capacity that can handle bigger, more complex models.
So that creates this need for continuous, multi-billion-dollar capital outlays, whether the old assets are fully depreciated or not.
And that puts enormous ongoing pressure on corporate treasuries.
We see that pressure reflected right on the balance sheets of these hyperscalers. Firms in this sector are allocating, on average, a stunning 60% of their cash flow from operations, their CFO, directly to CapEx.
That 60% figure is so critical. It means for every dollar they earn from cloud services or software, 60 cents is immediately eaten up by the need for new infrastructure.
It's an aggressive investment strategy for sure.
It's necessary to stay competitive, but it dramatically restricts their free cash flow. And this environment, high pressure, massive cost, constrained liquidity, is the genesis of our next topic, the circular financing loops that have become absolutely vital for survival.
Because the traditional financing model just can't move fast enough or provide liquidity at the scale they need.
Not even close.
Okay, so we've established this intense financial pressure. Now we have to talk about the solution they've found, circular financing.
This is the deal structure that's really emerged as the norm.
Why? Just because the cost is so high.
The cost of compute is so extreme that many of these promising AI startups, they simply cannot cover the expense with traditional cash flow or even venture capital alone.
So this is the mechanism that keeps the supply chain moving and, as we discussed, keeps the whole economy ticking over.
But it's a high-wire act. It really is.
Okay, so define that mechanism clearly for us. What exactly does circular financing actually entail?
Put simply, circular financing is a deal structure where one company provides funding to a second company. That funding could be capital, an equity investment, even low-interest debt.
Okay, that sounds like a normal investment. Where's the circular part?
The critical circular component is that the company that receives the money is then contractually obligated to use that money to purchase the original investor's products or services.
So chips, cloud capacity.
Exactly. The supplier is essentially lending the buyer the money to complete the purchase. In doing so, they create a guaranteed revenue stream for themselves. It's this web of equity swaps, service contracts, and infrastructure commitments all exchanged in a closed loop.
So it guarantees sales for the supplier.
And it guarantees critical infrastructure access for the buyer. It highlights this massive degree of interdependence that is basically structuring the entire technology economy right now.
The major players need each other desperately to scale this quickly.
They do, and the most famous and maybe the most scrutinized example of this involves Nvidia and OpenAI.
Right, walk us through that partnership dynamic.
This is the perfect illustration of the tango. Nvidia, the dominant chip manufacturer, invests a huge amount of capital. We've seen reports suggesting up to $100 billion in the broader AI ecosystem into foundational AI labs like OpenAI.
And in return,
In return, OpenAI pledges to purchase millions of Nvidia chips. Or they commit to these massive multi-year cloud contracts with Nvidia's primary partners, who are, of course, running Nvidia hardware.
and this spirals out into a whole hyperscaler ecosystem. I've heard it called the Three Stooges analogy in some financial circles.
That analogy is perfect because the money flows in a circle that makes everyone look incredibly financially robust.
So money flows from Nvidia to OpenAI.
Right, giving the AI lab the cash it needs to pay for compute. OpenAI then takes that money and commits to a major cloud provider like Oracle or Microsoft, locking in capacity for their massive model training runs.
And here's the crucial third step. Those cloud providers, they look at that enormous guaranteed multi-year revenue commitment from a huge player like OpenAI.
Which validates their own aggressive investment strategy.
And they take that validated revenue and funnel it right back to Nvidia to buy the chips they need to fulfill the contracts.
It creates a self-reinforcing, guaranteed feedback loop. Everyone is reporting massive quarter-over-quarter growth, but the initial capital injector was the hardware manufacturer itself. This interdependence ensures volume and liquidity, but boy, it also concentrates systemic risk among a handful of mutually reliant partners.
It's basically an exchange of a future financial promise for immediate critical hardware access. The suppliers guarantee a customer for their $40,000 GPUs.
And the AI labs get the compute power they need to even exist in this race against their rivals.
And we're seeing this dynamic elsewhere too, right? This isn't just an Nvidia thing.
Not at all. It proves it's the standard operating procedure. I mean, look at AMD's strategic deal. AMD struck a deal granting OpenAI equity warrants future ownership stakes worth up to 160 million shares.
And what did OpenAI have to do in return?
They had to commit to deploying 6 gigawatts of AMD GPU hardware by 2030.
That is a direct exchange of future ownership for a colossal hardware commitment.
It is. AMD secures this massive measurable deployment that helps them justify R&D and manufacturing scale-up. And OpenAI gets strategic capital tied to hardware access, which helps them diversify away from relying on a single vendor.
So both companies become strategically vital to the other's expansion plan.
Exactly. But the financing ingenuity doesn't stop with the giants. We're also seeing the emergence of these smaller, specialized players, the neo-cloud providers like CoreWeave and Lambda Labs.
And they've pioneered a way to secure financing using the physical hardware itself. This is where it gets really interesting.
This is where the sheer physical value of the GPU becomes its own currency.
How so?
These neoclouds are using the latest, most coveted chips, the Nvidia H100s and B200s, as literal collateral for multi-billion-dollar loans.
Because the chips are so scarce and in such high demand.
Financial institutions see them as a reliable, valuable, and easily liquidated physical asset.
And how much debt are we talking about here?
As of late 2025, over $20 billion in this kind of GPU-backed debt has been issued. It's completely transformed high-tech equipment into the collateral of choice for Wall Street.
And there's a structural element here that's really important.
A very critical element. A lot of this debt is structured through these sophisticated mechanisms called special purpose vehicles, or SPVs.
So what does that do?
The SPV is what buys the GPUs, funds the data center, and issues the debt. This allows the neo-cloud companies to keep those massive infrastructure liabilities off their primary corporate balance sheets.
So their immediate balance sheets look healthier, their free cash flow seems intact, and they can deploy capital faster to expand.
Right. But this structure also makes the risk assessment for investors much more complicated because they might not be seeing the full picture of the company's exposure to debt that's secured by this very specific, very rapidly obsolescing hardware.
It's a brilliant way to finance rapid expansion, but that reliance on circular financing, well, it immediately raises some critical historical parallels that should give us pause.
Oh, absolutely. Critics are drawing direct parallels to the late 1990s vendor financing bubble. The fiber optic boom.
Walk us through that history and why it's so relevant today.
Back then, the telecom sector was exploding, just like AI is today. Equipment manufacturers like Cisco and Lucent, they extended billions. Lucent alone committed over $8 billion in loans and guarantees to these cash-strapped internet service providers, ISPs.
Why? So those ISPs could afford to buy the manufacturer's networking equipment.
Exactly. It artificially inflated the sales figures of the manufacturers. They were reporting massive revenue growth, but that revenue was guaranteed by debt that they themselves had underwritten.
And then what happened?
The telecom companies failed to monetize their services. The revenue from their fiber networks just didn't materialize, so they defaulted on the loans. The equipment vendors were then forced to write off billions in debt, which exposed the, inauthenticity of their previous sales growth. Cisco saw its market cap slashed by hundreds of billions.
So what's the identical key vulnerability today?
It's simple. If the AI company's monetization disappoints, if that projected $2 trillion in annual revenue from AI doesn't show up, then the demand for the chips is revealed to be, well, inauthentic.
And the write-offs would just cascade through the entire ecosystem.
Hitting the hardware suppliers like Nvidia and AMD, the cloud providers like Microsoft and Amazon, hard. The entire interconnected financial web relies on the eventual large-scale and profitable deployment of these AI models.
The concentration of risk is almost breathtaking. We know how the dot-com bubble ended. Between March 2000 and October 2002, the NASDAQ composite fell 78%.
Wiping out trillions in market value.
And while you could argue today's underlying AI technology is more fundamentally transformational than fiber optics were, the financial structure supporting its deployment seems to carry the exact same inherent risk. Inflated sales reliant on self-funded buyers.
So the scale of this AI boom and the complex circular financial strategies supporting it are powerful drivers of economic growth.
No question.
But it's so crucial to recognize that this momentum isn't happening in a vacuum. It's being massively amplified by this explicit political and financial scaffolding that's being provided by government policy.
And that scaffolding is critical. It's what's helping these companies sustain that 60% CFO to CapEx ratio. We need to detail the political will that is dedicated to accelerating this infrastructure build-out, especially in the U.S.
Well, the U.S. government clearly views AI infrastructure as a strategic imperative. I mean, just look at the regulatory efforts from the Trump administration in 2025. They issued a series of executive orders, EOs, intended to implement these comprehensive industrial strategies.
And they were focused specifically on fast-tracking AI data centers and the energy infrastructure to support them.
And they weren't just waving a hand at data centers. They were highly specific. They defined data center projects as facilities requiring more than 100 megawatts of new electrical load specifically for AI use.
100 megawatts. That's a clear line in the sand. This is critical, high-impact national infrastructure.
And the central goal of these EOs was just systematic regulatory streamlining. They directed agencies to remove barriers, like complex environmental and permitting reviews, and to expedite construction timelines through things like the Federal Permitting Improvement Steering Council.
The goal being to cut years off the construction time for one of these $40 billion facilities.
Precisely. And the financial backing is explicit, directly targeting these massive buildouts. The U.S. Commerce Department was directed to launch specific initiatives offering financial support for what they called qualifying projects.
So those needing over $500 million in CapEx or that 100 megawatt load.
Exactly. And this support includes direct loans, loan guarantees, grants, and strategic tax incentives.
But the most immediate and, I think, profound impact on the hyperscalers' liquidity came through some very specific tax legislation.
This is where we need to unpack the One Big Beautiful Bill Act, or OBBBA, enacted in July 2025. This wasn't just a slight change to depreciation rules.
No, it was a fundamental shift in how corporations manage their assets.
It was a complete game changer. Historically, assets like servers, GPUs, all that specialized data center equipment had to be depreciated over 5 or 6 years. OBBA allows businesses to immediately deduct 100% of the cost of qualified property in the year it's placed in service.
So wait, what does that actually mean for a company like Microsoft if they spend $10 billion on new H200 chips in Q3?
They can immediately claim that entire $10 billion as a tax deduction for that year. Before OBBA, they could only deduct maybe $2 billion in that first year.
That's an immediate, substantial liquidity injection.
It's a huge boost. And it aligns perfectly with their aggressive expansion strategies because it effectively cuts their tax burden in the year of massive CapEx spending. It allows them to free up vast amounts of capital right now for reinvestment into even more CapEx.
It's structural financing provided by the tax code itself.
Right. And then you have the Inflation Reduction Act, the IRA, which expanded the investment tax credit, or ITC. This offers a minimum 30% credit for renewable energy systems used by data centers.
So solar arrays, battery storage, geothermal cooling systems?
All of it. And given the incredible heat these AI systems generate, these green energy systems are becoming absolutely necessary, not just, politically expedient.
And there's a crucial financial innovation in the IRA that really turbocharges this whole system.
The transferability option. This is key. If a data center developer has net operating losses and can't use those large federal energy credits immediately to offset taxes, they can sell those credits for cash.
They could just sell them to other profitable corporations who need the tax relief.
Yes, and this has created a robust secondary market. A data center developer gets immediate cash liquidity from selling the credit, which helps fund their next build-out. And the credit buyer, say a large manufacturing company, gets an instant 30% reduction on their tax bill.
So it effectively monetizes sustainability investments immediately. It's another circular flow of cash within the broader economy.
And if we connect this to the bigger picture, this isn't solely federal policy driving the build-out. State-level competition is fierce. At least 37 states now offer their own extensive tax incentives to attract data center investment.
Which shows how integral these facilities are seen for local economic growth and job creation.
Even though the actual local employment, once they're operational, can be pretty minimal.
And the incentives are often structured around these thresholds, right?
Yes. We see states offering property tax abatements, sales, and use tax exemptions on construction and equipment, reduced electricity tax rates.
For example, Ohio offers a complete or partial exemption on taxes on equipment if you meet minimum investment and job requirements.
Right. And Indiana exempts sales tax if you sustain minimum investments for at least 5 years. Kansas requires a huge $250 million investment and 20 new jobs for their comprehensive exemptions.
So states are basically bidding against one another using taxpayer funds to secure these crucial economic engines.
They are, but this economic scaffolding, designed for explosive growth, is hitting some unavoidable physical limits.
And that leads us directly to the infrastructure strain that's impacting communities nationwide. We have to address the physical bottleneck that threatens to strand billions in capital.
The AI-driven demand has been phenomenal. I mean, according to alerts from the North American Electric Reliability Corporation, or NERC, AI demand has added an estimated 20 gigawatts to the U.S. grid in just 1 year.
20 gigawatts, that's like adding several large metropolitan areas to the grid instantly.
It is, and this strain leads directly to this phenomenon of stranded capital, which is a nightmare for investors.
These are data centers built with billions of dollars of silicon, fully equipped with servers and networking gear.
But they can't be powered because of transformer shortages or aging transmission lines or just grid constraints. All of that GPU-backed debt suddenly looks very, very risky if the collateral can't even be plugged in.
And regulatory responses are inevitable when that physical strain meets community need.
Of course. A new Texas law, for instance, now requires remote-controlled shutoff switches for large data centers.
That's a direct operational intervention.
It's a huge intervention. It allows grid operators to forcibly cut power to AI facilities during periods of peak residential demand, like during an extreme summer heat wave or a winter storm.
So the law prioritizes community needs, keeping homes lit, hospitals powered over commercial compute.
It does, and it raises this really important question. Who governs the infrastructure that enables AI? The governance choice is being made right now, especially in these quiet utility commission dockets and zoning hearings, what will determine whether communities experience net benefits or, well, cumulative burdens.
Okay, so we've established that the AI economy is fueled by trillions in debt and interconnected capital. It's accelerated by these powerful tax breaks and government mandates for growth. But this entire structure is running on fundamentally resource-intensive model.
High energy consumption, high water use, and this rapid obsolescence that leads to just mountains of waste.
And that brings us to the counterforce. This massive global regulatory push demanding circularity and longevity.
The traditional linear take, make, dispose model of the AI hardware sector is just fundamentally incompatible with a finite planet and with long-term economic stability. It is a massive contributor to resource depletion and electronic waste, e-waste.
And the irony is that a lot of the rare earth elements and specialized components that are needed for the next generation of GPUs are becoming increasingly scarce.
Meaning the AI industry's own resource consumption threatens its own future expansion.
Exactly.
And that's why the transition to a circular economy is now being viewed not just as an environmental imperative, but as a strategic economic necessity for the long-term viability of the AI industry. If you can't efficiently reuse your inputs, eventually that $8 trillion capex projection just hits a physical wall.
And the legislative driver for this change, especially outside the U.S., is the European Union's Ecodesign for Sustainable Products Regulation, the ESPR.
The ESPR, published in June 2024, represents a massive paradigm shift in global regulation.
How so?
Historically, eco-design requirements focused on, energy-related products like washing machines or refrigerators. The ESPR extends these requirements to cover virtually all products placed on the EU market.
So that includes intermediate components, raw materials, finished tech goods, everything.
Everything, which means a US-based hardware manufacturer like Nvidia or a hyperscaler like Microsoft, if they want to sell services or components into the massive European market, they have to comply. And that fundamentally changes their global supply chains and product design.
And the requirements are incredibly comprehensive.
They are. They focus on about 20 different product parameters, including durability, reusability, repairability, energy efficiency, and recyclability.
And the EU's 2025-2030 working plan already lists several critical product categories that are being targeted first.
And many of them are essential for AI factories. They include these fundamental intermediate products that are vital to manufacturing the components themselves: iron and steel, with a 2026 adoption timeline, and aluminum in 2027.
So those timelines are forcing early changes in the raw material supply chain that will eventually feed the tech sector.
Right. And for the tech sector specifically, the ESPR mandates these crucial horizontal measures that are going to force immediate fundamental changes in product engineering. Two big ones stand out. First, mandatory requirements for product repairability, including the introduction of a detailed repairability score, which is planned for 2027.
So they can't just glue phones shut anymore.
No. And second, mandatory requirements on the recyclability of all electrical and electronic equipment by 2029. This means tech companies can no longer produce devices, from servers to consumer laptops, that are designed to fail. They have to design for repair, replacement, and resource recovery from the very start.
Which completely counteracts the planned obsolescence model that has driven tech growth for decades.
It does, and this whole push for longevity and circularity requires transparency. This increased demand for information is leading to a fascinating new tool for market traceability: the Digital Product Passport, or DPP.
The DPP sounds like a birth certificate and a maintenance log for a piece of hardware, but stored digitally.
That's exactly right. The DPP is designed to transform AI hardware from disposable commodities into durable, traceable, and valuable assets. It'll provide need-to-know data access on technical performance, environmental impact, sustainability, circularity, all along the entire value chain.
This mandatory regulatory structure is obviously forcing major companies to invest heavily in adapting their business models,
which in turn is creating entire new markets for reuse and recycling services. And we're seeing some really interesting responses from giants like Microsoft.
They're a clear leader here, right? Driven by their zero waste goal for 2030.
Their response has been highly strategic. They've invested in what they call circular centers. There are 6 of them operating globally, with 3 more planned by 2028. And these are not just recycling plants. They are sophisticated, purpose-built facilities designed to process decommissioned cloud hardware coming out of their massive data centers.
So walk us through what these centers actually do.
They're critical resource hubs. They triage decommissioned servers. They identify components that can be internally reused or refurbished, like perfectly good CPUs, power supplies, or networking cards. And only the truly obsolete or broken parts go to external recycling partners.
That internal reuse must be immensely valuable.
It is, and the financial impact has been immediate and impressive. In 2024, these circular centers helped Microsoft achieve a staggering 90.9% reuse and recycling rate, and they exceeded their 2025 target ahead of schedule. That scale is significant, both environmentally and financially.
And they're focused on design for longevity right down to the consumer level, too.
Absolutely, driven by that anticipated repairability score. Their new service devices, like the Pro 11th edition, have achieved an impressive 8 out of 10 repairability score from iFixit because they have at least 11 easily replaceable components, like the battery, the display, the SSD.
And we also see a major semiconductor manufacturer like Micron actively funding innovation in circularity.
Right, which benefits the entire ecosystem. It shows that resource efficiency is now a core investment thesis. Micron Ventures is supporting companies that enhance sustainability within the very complex, very resource-intensive semiconductor manufacturing process.
Like who?
They backed a company called Aqua Membranes, a clean tech startup using 3D printed technology to slash energy consumption in industrial water filtration. That's a process that uses immense amounts of water and energy in chip fabrication.
So they're using capital to indirectly address the resource footprint of their own manufacturing process.
Exactly. And they're also using AI to optimize their own internal processes. They're collaborating with a company called Multiscale Technologies to explore how AI can redefine the semiconductor manufacturing process itself, looking for new ways to optimize efficiencies that can scale to mass production.
Which illustrates a crucial point. The industry is trying to use AI to solve the very resource and efficiency problems that AI infrastructure creates. So we have this economic need for reuse that's driven by cost and a legal mandate for longevity driven by regulation. But there's a really big technical hurdle sitting right in the middle of these two powerful forces.
Data security.
The critical choke point.
It is. The reuse of high-value hardware servers, laptops, drives is essential for maximizing value in the circular economy. But if that hardware contains sensitive client data or proprietary AI models or confidential company information, you cannot safely reuse it or sell it or donate it without a complete, certified, and secure data erasure process.
And if you fail, you're looking at potentially catastrophic data breaches and massive compliance fines.
And for years, the lack of a modern, rigorous standard meant that many companies just defaulted to the safest but most wasteful option, physical destruction.
Smashing the hard drives.
Smashing the hard drives. Older standards, like the widely used NIST 888, just weren't keeping pace with modern storage technology. The explosion of new drive types, SATA, SCSI, and especially high-speed NVMe drives, meant that older overriding techniques were no longer guaranteed to eliminate data beyond recovery.
And that technical uncertainty was a massive barrier to circularity.
Because companies, rightly, prioritize security over sustainability.
So, enter the new technical gold standard for secure data sanitization, the IEEE 20A3-2022 standard.
This international standard is incredibly comprehensive. It provides updated, highly detailed technical guidance for sanitizing modern logical and physical storage media. And crucially, it specifically addresses the gaps left by the older standards, covering the media-specific techniques needed for today's high-density, complex drives.
And it does something else that's fundamentally important. It includes sustainability as a factor in the risk assessment process.
It institutionalizes sustainability. It recognizes that resource consumption is part of the cost calculation for data security decisions. The standard defines 3 primary methods for data sanitization based on the security level and what you want to do with the hardware in the future.
Okay, let's break down the first method, clear.
Clear uses logical techniques, like a standard overwrite or reformat. It's suitable for low-security information, where the main concern is just preventing recovery through simple, non-invasive methods. The device remains fully usable.
But advanced forensic techniques could still potentially recover data.
Potentially, yes. Which brings us to the critical one for enterprises that are seeking circularity: Purge.
This is the operational key.
This unlocks the circular economy for data-sensitive hardware. Purge uses advanced logical and physical techniques, pattern-specific overwriting, block erasing for flash drives, or cryptographic erasing that locks the data key to eliminate the data.
And the definition here is very strict.
Infeasible. Data recovery is rendered infeasible even with state-of-the-art laboratory techniques.
And the environmental consequence of using Purge, compared to the third option, is massive.
Absolutely. With Purge, the storage media and the device remain completely intact. They can be safely reused, refurbished, or sold on the secondary market. This allows that $40,000 GPU, or the server it's housed in, to retain its value and utility.
And finally, the third option is destruct.
Destruct is exactly what it sounds like: physical destruction. Incinerating, melting, or pulverizing the device to completely eliminate any possibility of recovery. This is reserved for the absolute highest security information, like national security data.
And the downside is obvious and permanent.
The device is rendered permanently unusable, contributing directly to the global e-waste problem.
The fact that this new standard explicitly includes environmental impact in its risk assessment analysis, well, that just changes the entire equation for corporate IT departments.
That's the critical guidance for the industry. The standard explicitly advises companies to prioritize the Purge sanitization method over destruct from most data. This professional validation ensures that enterprise-grade companies can comply with the highest security standards while still meeting their sustainability goals.
It makes the circular economy technically feasible for all this complex, data-sensitive AI hardware.
It does. And the ultimate payoff of this technical standard and the reuse that follows is just massive.
It is the ultimate decoupling of growth from consumption.
Absolutely. Quantified assessments show that circular economy approaches in the electronics sector could reduce material consumption by up to 70% and greenhouse gas emissions by up to 80% by 2050. Secure data erasure is literally the technical unlock needed to realize those environmental and economic benefits. So, if we synthesize this entire deep dive, the economic reality we're in is dual and it's heavily leveraged. The immediate engine of global growth is powered by this high-risk, interconnected circular finance, massive debt, and intense government promotion. It's the push for more, faster.
And meanwhile, the long-term viability and the resource footprint of that very engine are being aggressively regulated by governments demanding circularity, resource efficiency, and longevity. The push for better, longer.
Exactly.
So what does this all mean?
It means that the economy is caught between this imperative of immediate growth and the mandate for future sustainability. Every financial decision being made today, from multi-trillion-dollar AI capex commitments enabled by immediate tax deductions to the specific design of cooling systems funded by transferable tax credits, and even the adoption of the IEEE 2883 standard is linked by this fundamental tension.
The market wants rapid, explosive growth now, fueled by circulating money and hardware promises.
But the regulatory environment, especially in Europe, is mandating these sustainable, regenerative business models. The success of this dual system hinges entirely on whether the AI firms can actually monetize their growth and validate those sales before the vendor financing house of cards collapses.
And on the other side, whether the circular economy mandates can truly force companies to decouple growth from resource consumption.
If the AI boom is financing the economy today and the circular economy is its mandated future, then the true measure of success won't be in the immediate revenue generated from the sale of a brand new $40,000 GPU in 2025.
No.
It will be in the eventual certified profitability of that same GPU or its constituent components after it has been securely wiped via the Purge method, successfully refurbished and redeployed for a second or even a third life in 2030. That's what will prove that resource efficiency can conquer resource consumption. That shift from linear profit to circular value creation is the ultimate test of the system we are building right now.